So today we're going to discuss about section 186 of the Companies Act, dealing with intercorporate investments and loans by companies. Section 186. It's quite common for companies to make investments into other companies or to give loans or provide guarantees or securities to other companies. While years ago when the law was framed, the presumption might have been that it would be unusual for companies to make investments into other companies. But the reality of the commercial world today is that most companies proliferate themselves by forming companies around them. So they make investments in so-called subsidiaries, they make investments in so-called associates, and they finance the associates or subsidiaries by way of loans or guarantees or securities, thus leading to a very common activity in terms of intercorporate lending or investments. Section 186 has a long history, and I'll deal with the history in a short while from now, but let me first say, when it comes to making of investments by companies, Section 186 is not the only section. There are several sections that deal with making of investments. For example, Section 179 by 3, Roman E, talks about power of the board of directors to make investments. That is to say, when the company is making investments of its funds, the power would be exercised by the board. In other words, this is a board level decision. The board may, if it feels appropriate, the board may delegate the function, but if not delegated, the power would be exercisable by the board and at a meeting of the board. Section 177 by 4, Roman 4, empowers the audit committee to scrutinize the intercorporate loans or investments made by the company. Or what could possibly be the motive for the audit committee to make scrutiny of intercorporate loans or investments? The purpose seems to be that moving the money out of the company into other companies by way of loans or investments is funds moving out of the company, and such investments or loans need to be under the scrutiny of the audit committee. Question comes, at what stage would the audit committee scrutinize it? And the answer appropriately would be at the initial stage of making the loans or making the investments, as also on a regular basis. Because if the scrutiny is done only once and not thereafter, it would probably lose much of its meaning. Therefore, appropriately, the audit committee must scrutinize loans or investments on a regular, preferably annual basis. I'll also need to point out a section 19, which says subsidiary companies may not invest in shares of the holding company. Subsidiary companies are prohibited from investing in shares of the holding company, as that creates a circular or fake net worth. As after all, the holding company contributes to net worth of the subsidiary company, and the subsidiary company remits the money back as shares to the holding company. That creates a fake sense of circular net worth. Also, section 187 talks about companies to hold investments in their own name. In other words, whatever investments the company makes, the company must be holding it in its own name, and the investments made by the company also are to be recorded as a part of the board report. Now, this recording in fact can be done in the financial statements, and the board report can only make a reference to such annexures in financial statements where the particulars of loans and investments covered by section 186 are contained. The relevant rules for the purpose of investments is rule 11 of the meeting of board and its powers rules, so we need to refer to the rules as well. And I also need to say that if the company ever wants to exceed the limit of section 186 by 3, we're going to talk about that in terms of lending, giving loans to companies, then the approval of general meeting will have to be obtained by postal ballot in terms of the rules framed under section 110. So we talked about several sections dealing with making of loans or investments, and let's now return to section 186 itself, which primarily does what? Primarily limits the powers of board of directors to make intercorporate investments or to give loans to entities within a certain limit. Now, interestingly, it would be interesting to examine as to what could be the purpose of imposing this limit. Is this limit a common limit in corporate laws of other countries? Quick answer seems to be no. This provision is not usually found in corporate laws of other countries. Now, if we track the history, we find that what is Section 186 now was Section 372A in the Companies Act 1956, and 372A itself came by virtue of amalgamation of Sections 370 and 372, separately dealing with intercorporate loans and investments in the 56 Act. Sections 370 and 372 were the few remaining sections that remained after the deletion of the so-called managing agency system that happened in 1969. As you would observe, lots of sections around Section 370, 372, both before and after, got deleted. Section 370 and 372 remained as remnants even after the abolition of the managing agency system way back in 1969. So we would continue taking this a bit further. We find that these sections were actually there in the Companies Act 1913, and they were inserted way back in 1936 in form of sections 87A to 87I of the Companies Act 1913. These sections were introduced as controls on powers of managing agents. When the managing agency system existed, a managing agent could actually be one single agent for several companies, and an agent could quite often misuse his powers over companies so as to lift the funds out of company X and park the funds in company Y. So if the companies under the same management, that is under the control of managing agent, and managing agent was prohibited from investing the funds of company 1 into company 2, both under the powers of the same managing agent. And therefore, if one recalls properly, originally sections 370 and 372 both were actually restricting making of investments in companies under the same management, and therefore a very popular definition existed in section 371B defining what is companies under same management, because the idea basically was to curb the powers of managing agent to make investments in companies under the same management using his overarching powers under a bunch of companies which he was managing. So it sounds surprising that a bunch of sections which were rooted in 1936, so dating back to 80 years in the past, still continue to trouble companies even currently, while the sections have apparently lost their purpose. Managing agency system itself got abolished, but in 1980, in 1960s, the so-called Justice Vivian Bose Commission, which inquired into the alleged irregularities of the so-called Sahu Jain and Dalmia Group companies, it recommended further tightening of the sections, and in 1990s, late 1990s, pursuant to recommendations of the Chandratre Committee, these two sections 370, 372 were merged and kind of simplified into a section 372A, providing composite limits on making of loans or investments by companies. So that's the kind of broad history. And let's straight move to what are the main components of section 186. So section 186 talks about 186/1 talks about making of investments through layers of investment companies. While this section is on its way out, as it's recommended to be deleted by the Companies Amendment Bill 2016, but a quick history as to why this section could probably be existing. The original bill of 2008 contained similar section that companies would not be making investments through several layers of investment companies, as that tends to cloud or obfuscate the source from where the money is coming. So if money is coming into a company, it should be easy to identify where the money is coming from instead of having to travel several layers to see where the money is actually flowing from. So subsection 1 tends to restrict the number of layers of investment companies, but this section anyway is on its way out, therefore let's not discuss it much at length. Subsection 2 provides the limits within which the board of directors of companies could give loans to other persons or provide guarantees or securities in connection with such loans or make investments in securities of companies. Originally, section 372A dealt with loans to companies only, but section 186 of the present act is not restricted to loans to companies, extends to loans to other persons as well. So loans to other persons or guarantees in connection with loans or provision of securities in connection with loans, that forms one bunch of the section. Let's call it loan and non-related restrictions. And the second bunch of restriction is investment in securities of other companies. So both of these put together, the board of directors of companies may go up to 100% of the company's free reserves, that includes of course share premium, or 60% of the company's paid up capital and free reserves, the higher of the two. In essence, therefore, to the extent the company has retained money in form of free reserves, the board of directors can invest it all. If the company has partly retained profits and partly paid up capital, the board of directors can go up to 60% of the company's paid up capital and free reserves. 186/3 says previous approval of the company by way of a special resolution in general meeting would be required in case the board wants to exceed these limits. Recall I did mention by virtue of section 110, if the companies wanted to exceed the limits for the purpose of making of loans, in that case such approval will have to be obtained by postal ballot. That is to say, postal ballot will not be required in case the company is exceeding the limits for the purpose of making investments, but if the company is exceeding the limits for the purpose of making of loans, then the special resolution will be by way of a postal ballot. Now the question, subsection 3 says previously approved by the company in general meeting. So the question obviously comes, what if the board has already exceeded the limits and the previous approval of the company in general meeting has not been obtained? So if the company is not granted previous approval, is it okay for the company to grant a post facto ratification? This question obviously is quite a complicated question, and once again going to the history of section 372A, it's noted that it was in year 1989 that the approval, at that time the approval in 372 was the approval from central government, and the provision of law was amended to insert the approval of central government had to be previous approval. Now that the approval is not external, the approval is internal, the approval is from the company itself, can the company subsequently do a ratification if the board has exceeded the limits put in subsection 2 already? So the issue is, when the board exceeds the limits put in subsection 2, is it excess of the company's corporate power, or is it exceeding the board's power? Is it does subsection 2 lay a limit on the power of board of directors while it's still within the powers of the company, or does subsection 2 put a restraint on the power of the company itself? There's no question of the company exceeding the power of the company itself, but if what is exceeded is the power of the board, the question might always be, can the company, as having the ultimate original power, can the company grant and can the company exonerate or confirm or ratify the action of the board of directors if the board has exceeded the limit set as the powers of the board of directors? One of the fundamental principles of ratification is that if the general meeting ratifies an action, ratification dates back to the date on which the action was originally taken, as if the consent of the ratifying authority was always there. So even though subsection 3 continues to use the word previous approval, it's not as if the board has gone ahead and made investments. That doesn't seem to be breach of corporate powers, and therefore the company using its own powers might grant an extension, and might also grant an extension retrospectively from the date on which the board first exceeded the power, and therefore, for instance, ratify the excess, if at all, done by the board. Subsection 4 of section 186 talks about disclosures in financial statements of the loans or investments done in pursuance of section 186. I did mention earlier that this is also required as a part of the board's report in section 134, and commonly companies make the disclosure at one place, mostly in case of financial statements, and then give a cross-reference as a part of the board report. Subsection 5 is a very important section. Subsection 5 says any loan or investment made by the board in pursuance of section 186 will have to be done with unanimous approval of all directors present in the relevant board meeting. Additionally, this subsection also says that if there is a borrowing from public financial institutions and if there is a default in such borrowings, the making of the loan or making of investment will also require approval of such public financial institution from which there is a loan outstanding. Assuming for a minute there is no loan outstanding from public financial institution, or there is a loan but there is no default, we come back to the question, unanimous approval of board of directors. Now if you read section 186 subsection 5 with section 179 by 3, and we referred to section 179 by 3 earlier, we said 179 by 3, proviso to 179 by 3 says the board of directors may delegate the power to make loans or make investments to either a committee or to a principal officer. And 186 by 5 at the same time says when the board exercises the power to give loan or make investments, it must do so by unanimous resolution. So if the board can actually delegate the power, where is the question of unanimous resolution? And there seems to be an apparent conflict between 186 by 5 and proviso to 179 by 3. A fundamental principle of law is that if there is an apparent conflict in two provisions, we interpret the provision such as to arrive at a harmonious construction. Harmonious construction would mean we need to so interpret the section that both provisions actually remain and one provision doesn't get killed by interpreting the law. So a harmonious construction would therefore mean that if at all the board decides to delegate the power to make investments, the delegation must be done with unanimous approval of all directors. Once the board has actually delegated the power, it's not the board that is deciding to make investments or give loans. It's the delegated authority, for example, the committee or the principal officer, who decides that, and therefore there is no question of the loan or the investment at all coming to the board unless the limits within which the delegated authority can make loans or investments gets exceeded. Subsection 6 sounds like a very confusing provision. It's a limit on powers of SEBI registered securities intermediaries from accepting loans as per SEBI regulations. There are apparently no such limits within which SEBI intermediaries may accept loans, but if at all SEBI chooses to put some restrictions, the restrictions would be applicable in terms of company law restrictions also. Subsection 7 is quite an interesting provision, and subsection 7 says where the company wants to give a loan to any person, the rate of interest on such loan shall not be less than the yield prevailing on a risk-free security, government treasury, of near term, near maturity. For example, if I'm giving 1 year loan, I'll need to check with yields on 1 year government security. If I'm giving a 3 year loan, I'll need to check return on 3 year government treasury, and the rate of return, rate of interest on the loan cannot be lesser than the yield on risk-free government securities. What could be the purpose of this section? The purpose is quite simple. Risk-free rate of return represents the least rate that could probably prevail on loans in a system. And since you're lending not to a risk-free entity but to risky entities, the rate of interest you could charge on such loans cannot be lower than the so-called sovereign or risk-free rate. Now, while this section sounds understandable, the issue is, if for example I'm making an investment in debentures and the debentures carry a yield which is lower than the spreads on risk-free, the rates on risk-free securities, will that be hitting section 186 by 7? 186 by 7 as it is worded seems to be applicable to loans, and therefore literally the section would stay limited to loans only. Another very common difficulty in implementing 186 by 7 is in case of loans expressed in currencies other than INR. For example, let's say you got a Singapore subsidiary and you want to give a loan to a Singapore subsidiary. The rate of interest in Singapore dollars or rate of interest in, let's say, US dollars can no way be comparable with the rate of return on central government treasuries which are expressed in INR. If I had government treasuries expressed in similar currency, which unfortunately we don't have, we could probably compare the yields of the Indian government treasuries of that particular currency. We don't have that, and therefore the only proxy that we could probably use is that if there are PSU securities, obviously now PSU securities cannot be more safe or less in terms of rate of return than the government of India itself. If you got PSU securities of a near maturity, which are, let's say, AAA rated, and the yields of those are available in the relevant currency, we could use that rate as the benchmark so as to ensure that we're not lending to entities in different currencies at rates which are lower than the rates of return on PSU securities. Subsection 8 talks about companies which have defaulted in repayment of deposits not to give loans or make into company investments. Not a section difficult to understand. Subsection 9 talks about the company having to maintain a register in which the company would keep records of loans and investments. This is also dealt with. This is one of the registers which is open for inspection as well. And subsection 10 says this register will be kept at the registered office of the company and will be open for inspection. Subsection 11 is a very important section. It talks about exemptions to certain companies from provisions of section 186. Exemptions obviously pertain to the two basic limbs, the two basic branches of section 186 are loans, guarantees or securities on one hand, and making of investments in shares or corporate securities on the other hand. So exemptions in section 186 by 11 also are exemptions from, either exemption from the provisions pertaining to giving of loans, etc., or exemption from provisions pertaining to making of investments. As regards lending exemption, lending once again also obviously includes lending, guarantees or securities. Lending exemptions are applicable to a banking company, insurance company, housing finance company, a company engaged in financing of other companies. We need to read it with Rule 11 by 2 of the meetings of the board or its powers rules, which says that if the company is financing other entities that's taken as companies in the business of financing other companies, or the exemption is also available for companies in the business of providing infrastructural facilities. The word infrastructure in context of Companies Act has to be read in light of Schedule 7, and Schedule 7 interestingly has a much larger list of infrastructure items than the list adopted by the Reserve Bank of India or the Government of India. So the lending exemption therefore is available primarily to lending companies and to infrastructure companies. The investment exemption, which is the other branch of section 186, is applicable to making of investments by non-banking finance companies, investment companies or companies which are in business of making of investments. So the interesting point seems to be, if the company is a non-banking finance company, however in lending business, is it exempted from making of investments? Prima facie the answer seems to be no, or vice versa, if the company is in business of making of investments, is it exempt from the limits applicable to giving of loans? Now while the wording of subsection 11 is little confusing in this regard, the provisions of the Companies Amendment Bill 2016 seem to be clarifying that and seem to say that the lending exemptions are applicable to lending companies, investment exemptions are applicable to investment companies. Reading through Rule 11 by 1 of the meetings of board and its powers rules, we get that investments in wholly owned subsidiaries or loans to wholly owned subsidiaries or joint ventures are not to be included while counting the limits of section 186 by 3. Now, in practical implementation of section 186 by 3, one common question that commonly comes is the meaning of the word paid up capital and free reserves, as the limits of section 186 are 60% of paid up capital free reserves or 100% of free reserves. Therefore, the question obviously is what's the meaning of free reserves? As intuitive answer to the meaning of free reserve would be, free reserves mean anything which is free for distribution by way of dividends, and therefore one would at first blush take an approach that even the credit balance lying to the credit or P&L account will also be a free reserve. Now if you read the definition of free reserve in section 2 subsection free reserves as defined in section section 243. Now we get a conclusion that an amount lying to the credit or P&L account may actually not be taken as a reserve at all, because an amount becomes a reserve only when the board of directors take a conscious action to shift an amount from the credit or P&L account and transfer it to a reserve. Reserves might mean general reserves as commonly called. Reserves might also be dedicated reserves to a specific purpose, but then the question is whether it's free or not. That becomes a significant question. But if the amount is simply lying to the credit or P&L account, is it a reserve? It might definitely be called a surplus, but is it a reserve? The answer seems no. Now while the statute, the Companies Amendment Bill, is trying to correct the definition of net worth to address this issue, but the definition of free reserve still remains unattended, and therefore it might be such that companies have a substantial balance of surplus, that is credit balance in P&L account, lying to the credit of P&L account, and yet it may not form part of the free reserves. This I think should act as a quick summary of section 186, and obviously look forward to interacting with you all. Thank you very much.